Do you really own your money, or are you just holding it for someone more powerful, the government, the banks, or the entire global financial system? The answer might shock you. Wealth Cipher warmly welcomes you. Follow our channel so you won't miss any valuable insights to help you take control of your financial destiny. Now, let's dive into the analysis. Here's a truth that's hard to swallow. The money in your wallet, in your bank account, it's not truly yours. It sounds crazy, right? But let me explain. Money is a product of the government. It's just paper or numbers backed by a system. It has value only because people trust that system. The wealthy understand this better than anyone. They don't cling to money as if it were an unchanging asset. They treat money as a tool, a vehicle to acquire real, tangible assets that generate true value over time. Poor people earn money, save it in the bank, and believe they're safe. The middle class buys houses, cars, and thinks they're investing. But the rich, they send their money to work. They invest. They acquire income-producing assets. Keeping money idle is dangerous. Idle money is dead money. Inflation eats away at its value every single day. That's why the rich never let money sit still. Money isn't something you hold, it's something you move, something you control. The more control you have over cash flow, the closer you are to financial freedom. So, do you really own your money? Or are you just temporarily holding it for a system that's designed to keep you working forever? The rich understand this, and that's why they grow wealthier every day. But here's the question. How can you turn dead money into living money? How can you make your money work for you instead of the other way around? We're about to uncover the secrets, starting with the mindset that separates the wealthy from everyone else. Now that we've set the stage, let us break down why money, this thing you work so hard for, isn't really what you think it is. Here's the first shocking reality. Money is an illusion. Yes, you heard that right. It's a man-made construct, backed not by gold, not by diamonds, but by trust. Your dollars, euros, yen, they're all fiat currency. That means they have value because governments say they do, and because people believe in that system. But what happens when that belief fades? History has shown us again and again. Currencies collapse, empires fall, paper money becomes worthless. Think about the German mark during the Weimar Republic, the Zimbabwe dollar during hyperinflation, or even the current debates about the US dollar losing its dominance. The system is designed to favor those who understand the rules. And guess what? Most people don't even know the game exists. The rich play by a different set of rules because they know something crucial. Money is not wealth. Let me repeat, that money is not wealth. So what is wealth? Wealth is ownership of assets that produce value over time: real estate, businesses, intellectual property, stocks that pay dividends. Wealth is something that grows even when you're asleep. Wealth is something that protects you against inflation and economic shocks. Here's the cruel joke. The majority of people spend their lives chasing money, not wealth. They trade their time, their most precious non-renewable resource, for a paycheck. They store that paycheck in a savings account that earns maybe 0.01% interest, while inflation silently eats 5%, 7%, or even 10% of their purchasing power every year. And what do banks do with your money? They don't just keep it safe for you. They take it, they lend it, they invest it, and they make massive profits. The system literally rewards them for holding your money while you think you're being responsible by saving. This is why Robert Kiyosaki famously said, "Savers are losers." Harsh, maybe. True, absolutely. Because when you save in cash, you're losing value every single day. Now, here's the part that's really going to twist your brain. Money isn't just controlled by banks and governments, it's as controlled by debt. Every dollar in circulation was created through debt. When governments borrow, they issue bonds. When banks lend, they create money out of thin air through fractional reserve banking. It's all a giant credit-based system. So, if the system is built on debt, who wins? The borrower, if they borrow to buy appreciating assets. Who loses? The saver, who clings to cash like a safety blanket, while its value melts away. The wealthy understand this. They don't just avoid debt, they leverage it. They use other people's money to acquire assets. They let inflation work for them instead of against them. They understand the game. And that brings us to a fundamental truth. If you want to break free from financial slavery, you must stop thinking like the masses. You must stop thinking like a consumer and start thinking like an investor. But how do you do that? How do you shift from playing defense, saving money, cutting expenses, to playing offense, creating wealth, generating cash flow? To answer that, we're going to take a deep dive into the mindset of the wealthy. And then, I'll show you a real-world example of someone who mastered this game like no one else. Warren Buffett. So far, we've uncovered the brutal truth. Money is an illusion, and the system is designed to keep most people trapped. Now let's take it one step further and explore the real game changer, the mindset of the wealthy. Because here, as the truth, wealth begins in the mind long before it appears in your bank account. The average person believes that working harder equals getting richer. The wealthy know that's a myth. If effort alone created millionaires, construction workers and nurses would be billionaires. Hard work is important, but it's not enough. You need leverage, and leverage starts with thinking differently. Let's break down some key differences between the mindset of the poor, the middle class, and the wealthy one. The poor focus on survival. When you're poor, your mind is occupied with one thing: getting through the month. How do I pay rent? How do I cover bills? There's no bandwidth left to think long-term because survival mode hijacks your brain. This isn't about intelligence, it's about perspective. When every dollar counts, risk feels terrifying. 2. The middle class focus on comfort. The middle class is obsessed with security, steady jobs, saving for retirement, buying a house, and maybe a nice vacation once a year. They think being debt-free equals financial success. They work hard, climb the corporate ladder, and hope for a pension or a 401k. And guess what? That strategy worked decades ago. Today, it's a recipe for disappointment. Inflation destroys savings. Jobs aren't secure. Retirement funds aren't guaranteed. 3. The wealthy focus on growth and leverage. Here's where everything changes. The wealthy don't think about how to earn more by working harder. They think, how do I make my money work for me? They understand that assets, not effort, create real wealth. They ask questions like, how can I turn $1 into $10 without working 10 times harder? How do I build systems that make money while I sleep? How do I create value for millions instead of working for one employer? And most importantly, the wealthy don't fear risk, they manage it. They know that playing it safe is actually the riskiest move of all. The core principle: money is a tool, not a goal. Most people chase money as if it's the ultimate prize, but the wealthy see money as a servant, not a master. It's simply a tool to acquire assets, build businesses, and create freedom. They don't hoard money, they deploy it. They move it into places where it multiplies: real estate, stocks, private equity, intellectual property. Think about Warren Buffett. When he buys a company, he's not thinking about how much cash he has today. He's thinking, will this business generate cash flow for decades? Will it grow without me working in it? That's the mindset shift. Scarcity versus abundance. The poor and middle class operate from scarcity. There's only so much money to go around. They compete for slices of the pie. The wealthy operate from abundance. If I create value, I can bake a bigger pie. They don't think in terms of limits. They think in terms of opportunities. Linear income versus residual income. Here's another critical difference. Linear income equals you trade time for money. You stop working, the income stops. Residual income equals you do the work once, and the money keeps coming. The wealthy build residual income streams: royalties, dividends, rental income, business profits. That's why you see billionaires like Jeff Bezos or Elon Musk focusing on building massive companies. It's not about a paycheck, it's about systems that generate wealth at scale. The risk misconception. Most people think investing is risky, but do you know what's actually risky? Working 40 years for one employer and hoping they don't fire you. Saving cash while inflation destroys it. Depending on a government pension that may not exist when you retire. That's the real risk. The wealthy embrace calculated risk because they know inaction is the most dangerous move of all. Now, you might be wondering, okay, I get it. I need the right mindset. But how do I start? What's the first step? The answer: education. Because let me tell you something, they don't teach this in school. Schools train you to be an employee, not an investor. They teach you how to pass tests, not how to pass wealth down to your children. You have to unlearn the programming. Stop thinking like the masses. Start studying the playbook of the wealthy. And that brings us to one of the greatest wealth builders in history, a man whose strategies are studied by billionaires and beginners alike. Warren Buffett. In the next section, we'll dive into his world, break down his principles, and show you exactly how he turned $100 into billions and how you can apply the same strategies in your own life. Now that we've explored the system and the mindset of the wealthy, it's time to take a deep dive into the strategies of one of the greatest investors of all time, Warren Buffett. Why Warren Buffett? Because he's not a tech genius like Elon Musk. He didn't create the next iPhone like Steve Jobs. He didn't build an empire from oil like Rockefeller. Instead, he used principles, timeless, simple principles that anyone can learn. If you truly want to master wealth, you need to understand Buffett's playbook. And guess what? His strategies are not a secret. He talks about them openly. The problem is, most people ignore them because they seem too boring, too slow. But in a world obsessed with quick wins and overnight success, Buffett proves that patience, discipline, and intelligence beat speed every single time. So grab your notebook, because what I'm about to share could change your financial life forever. Step 1. The power of compounding. The eighth wonder of the world. Albert Einstein famously called compound interest the eighth wonder of the world. Warren Buffett calls it his best friend. And here's why. Let's do a quick example. If you invest $1,000 at 10% annual growth in 1 year, Buffett started investing at age 11 today. He's worth over $120 billion. But here's the kicker. $100 billion of that came after he turned 60. Why? Because compounding takes time. The first few decades feel slow, then the snowball explodes. That's why Buffett says, the best time to plant a tree was 20 years ago. The second best time is now. Most people kill compounding because they want fast money. They panic during market dips. They sell early. They chase trends. Buffett does the opposite. He buys and holds. For decades, your lesson. Start early, stay consistent, and let time be your ally. Step 2. Rule number 1. Never lose money, and rule number 2. Never forget. Rule number 1. Buffett's most famous quote isn't about making money, it's about not losing it. Why? Because when you lose 50%, you need 100% just to break even. Risk management is everything. Buffett avoids speculation, fads, and things he doesn't understand. He calls them too hard piles. Think about 2000, the dot-com bubble. Buffett didn't chase it. 2008 financial crisis, he didn't panic, he bought more. He knows that avoiding major losses keeps the compounding machine running. Key takeaway: don't gamble. Don't invest in something just because it's trending. Ask yourself, do I understand this business? Will it be around in 10, 20 years? Would I still buy it if the market closed for a decade? If the answer is no, move on. Step 3. Buy businesses, not stocks. Most people see the stock market as a casino. They buy because the price is going up and sell because it's going down. Buffett doesn't play that game, he says. When you buy a stock, you're buying part of a business. Think like an owner. Buffett looks for businesses that meet these criteria. Strong moat, a competitive advantage that protects them from rivals. Think Coca-Cola, Apple. Predictable cash flow, businesses that will keep making money regardless of trends. Great management, honest, capable leaders who allocate capital wisely. Fair price, not cheap, not overpriced. Buffett loves value, not bargains. For example, Coca-Cola. Buffett bought it in 1988. People thought he was crazy as soft drinks. But Buffett understood something. People will always drink Coke. And 35 years later, he's still holding your move. Stop thinking like a trader. Think like an owner. If you wouldn't own the whole business, don't buy a single share. Step 4. Patience is your superpower. Buffett's favorite holding period: forever. He doesn't jump in and out of stocks. He doesn't care about daily price movements. Why? Because he buys businesses that he's happy to own forever. The average investor, they check their portfolio 10 times a day, panic at the first sign of red, and sell low. Buffett, he says, the stock market is a device for transferring money from the impatient to the patient. That's the game. Be patient, and you win. Step 5. Live below your means even when you're a billionaire. Here's something shocking. Buffett is worth over $120 billion, yet he still lives in the same house he bought in 1958 for $31,500. He drives a modest car. He eats McDonald's breakfast. Why? Because wealth isn't about showing off, it's about freedom. Most people upgrade their lifestyle as income grows. They buy bigger houses, luxury cars, designer clothes. Buffett doesn't. He knows that money buys security, not status. Lesson for you: don't let lifestyle creep kill your wealth. The more you spend, the more you need to earn. Instead, reinvest the difference. Let your money grow. Step 6. Avoid debt like the plague. Buffett hates unnecessary debt. He calls it financial poison. Why? Because debt kills flexibility. It forces you into decisions you wouldn't make otherwise. He says, if you're smart, you don't need it. If you're dumb, you shouldn't be using it. Sure, Buffett uses leverage carefully in his businesses, but for personal finance, he avoids it like fire. If you're carrying credit card debt at 20%, stop investing, pay it off first, because there's no point earning 8% in the market while losing 20% to debt. Step 7. Continuous learning. Buffett spends 80% of his day reading. He calls knowledge compound interest for the mind. Every book, every annual report, every business analysis adds to his advantage. His advice: read 500 pages a day. It sounds extreme, but even 30 minutes a day puts you ahead of most people. Start with these books: The Intelligent Investor by Benjamin Graham, Common Stocks and Uncommon Profits by Philip Fisher, Buffett's Annual Letters, free online. Knowledge builds confidence, confidence builds patience, and patience builds wealth. Step 8. Think long-term, act decisively. Buffett waits for the right pitch. He doesn't swing at every opportunity, but when the perfect one comes, he bets big. He says, opportunities come rarely. When it rains gold, put out the bucket, not the thimble. That's why during market crashes, Buffett buys aggressively while everyone else is panicking. He's collecting assets at a discount. Buffett's success formula in one sentence: be fearful when others are greedy, and greedy when others are fearful. That mindset has made him billions. In the next section, we'll take all these principles and translate them into a practical roadmap for you step by step. You don't need billions to start. You don't even need thousands. You just need the mindset, the discipline, and the right strategy. So let's dive into how you can apply the Buffett playbook to your own financial life. The psychology behind wealth. How Buffett thinks differently. Let's talk about one of the most underestimated aspects of becoming wealthy: mindset. You see, wealth is not just about numbers. It's not just about buying stocks, owning real estate, or having a business. It starts in your head. If you think like the majority, you will live like the majority. And the majority is not rich. Warren Buffett didn't just make money because he picked good stocks. He made money because he thinks differently about money. So, what is this mindset difference? First, let's revisit the basic truth. Most people work for money. They wake up, go to work, spend 8 to 10 hours every day trading their time for a paycheck. That's the employee mindset. Buffett never subscribed to that. Even when he was a teenager, he wasn't thinking, how can I earn $10 an hour? He was thinking, how can I make $10 while I sleep? That's the investor mindset. The rich don't ask, how much will this cost me? They ask, what will this make me? They don't think in terms of expenses. They think in terms of assets and returns. If Buffett buys a stock, he's not asking, can I afford this today? He's asking, how much cash flow will this create for me for the next 10 years? Here's something fascinating. Warren Buffett still lives in the same house he bought in 1958 for $31,500. Does that mean he's cheap? No, it means he understands value versus cost. He spends where it matters, on investments that grow, not on status symbols that depreciate. The difference between wealthy people and everyone else is this: wealthy people delay gratification for exponential growth. Most people trade long-term growth for short-term pleasure. Now, let's break down a few psychological principles. Buffett lives by one: the power of patience. If there's one thing Buffett is famous for, it's his patience. He once said, the stock market is a device for transferring money from the impatient to the patient. Read that again. Most people want to double their money overnight. They jump into whatever is trending: crypto, meme stocks, whatever the internet says is hot. Buffett, he's happy to wait 10 years for a good return. That's why he wins. Patience is not passive. Patience is active discipline. It's waiting with a strategy. It's saying no to 99 opportunities so you can say yes to the one that will make you rich. In his own words, the difference between successful people and really successful people is that really successful people say no to almost everything. 2. The importance of certainty. Buffett doesn't gamble. He doesn't speculate. He invests where he understands the business and can predict future cash flow with confidence. He calls it the circle of competence. Most people lose money because they try to be experts in everything. Buffett stays in his lane. If he doesn't understand it, he doesn't touch it. This applies to life too. Don't invest in something just because your friend said it's good. If you don't understand how it makes money, walk away. 3. The art of compounding. We touched on compounding earlier, but let's dive deeper. Buffett's wealth didn't come from doing something extraordinary every day. It came from doing the ordinary consistently for decades. Compounding works like magic, but only if you give it time. Here's the kicker. Buffett made 99% of his wealth after the age of 50. Think about that. He started early, but the massive snowball effect only happened later because compounding needs time to explode. If you start today and stay disciplined, your future self will thank you. 4. The emotional game. This is where most people fail. Investing is emotional. The market crashes. People panic and sell everything. The market booms. People get greedy and buy at the top. Buffett does the opposite. He says, be fearful when others are greedy, and greedy when others are fearful. That takes emotional control. If you can master your emotions, you can master money. The reason most people stay broke is because they let fear and greed make decisions for them. 5. The long-term vision. Buffett never plays for short-term wins. He's always thinking in decades, not days. Ask yourself, are you making decisions for the next 30 years or the next 30 days? That difference will decide your financial destiny. Now, let's add an actionable takeaway for you. If you want to build wealth like Buffett, don't just focus on what to buy or where to invest. Focus on how to think. Train your brain to see money as a tool, not a goal. Money should work for you, not the other way around. In the next part, where I'll talk about something that changes everything. The concept of cash flow and how to create multiple streams of income like Buffett himself. This is where the real game begins. Stay tuned. Cash flow is king. How Buffett creates multiple streams of income. When people think of Warren Buffett, they think stocks. But here's the truth. Buffett doesn't just invest for price appreciation. He invests for cash flow. He doesn't care if a stock goes up tomorrow or down next week. He cares about one thing: how much money this company will put in his pocket for the next 10, 20, or 50 years. This is where the real secret lies. It's not just about getting rich, it's about staying rich. And the key to that is cash flow, money that comes in whether you get out of bed or not. 1. Why cash flow matters more than price. Most people invest thinking, I hope this stock price goes up. That's called speculation. Buffett invests thinking, I hope this company keeps paying me money every year for decades. That's called ownership. He's not renting stocks, he's buying businesses. Here's the principle. You don't live on net worth, you live on cash flow. You can have $1 million in assets, but if they don't pay you anything, you're broke. Buffett makes billions in dividends from companies like Coca-Cola, Apple, and American Express because these businesses generate steady profits and they share those profits with him. 2. How Buffett chooses cash flow machines. Buffett asks one question before buying. If the stock market shut down for 10 years, would I still be happy owning this business? That's why he invests in companies like Coca-Cola. People drank Coke 50 years ago, they drink Coke today, and they'll probably drink Coke 50 years from now. Predictability equals stability, and stability equals consistent cash flow. He avoids businesses that rely on hype or trends. If the business needs constant reinvention or relies on unpredictable consumer behavior, Buffett stays away. Actionable tip. Before you invest, ask, will people still need this product in 20 years? 3. The Buffett model for multiple income streams. Most people have one income stream, their job. If that stops, they're done. Buffett, he has hundreds of income streams. Every company he owns sends him a piece of their profit. He doesn't rely on luck. He relies on systems of cash flow. Here's a quick breakdown of Buffett's approach. Dividends from stocks. Coca-Cola, Apple, Chevron pay him millions every quarter. Private businesses. Through Berkshire Hathaway, he owns companies like Dairy Queen and Geico. Interest from bonds. Yes, even bonds for predictable returns. Other assets, real estate indirectly through businesses. Lesson: don't just have one income stream. Build multiple. If one dries up, the others keep flowing. For cash flow versus salary, Buffett once said, if you don't find a way to make money while you sleep, you will work until you die. Read that again. That's the game. Your salary stops when you stop working. But if your investments pay you cash flow, you're free. Freedom is not about how much you make in a year, it's about how much you earn without working. 5. How you can start creating cash flow. Invest in dividend stocks. Start small. Even $50 a month invested in a dividend stock compounds over time. Start a side business, something that runs without you after setup, like digital products or online content. Buy assets, not liabilities. A car takes money out of your pocket. A rental property puts money in. Reinvest earnings. Don't spend your dividends, reinvest them to accelerate growth. Think of it this way. Your goal is not to get rich. Your goal is to create a system where money works harder than you do. Buffett doesn't wake up wondering if he has enough cash. His businesses and investments are working for him 24/7 even while he sleeps in Omaha. In the next section, we'll talk about something most people ignore but Buffett never does: risk management and the rule of never lose money. This is where we separate amateurs from professionals. Risk management. Buffett's rule number 1. Never lose money. If you've ever heard Warren Buffett speak, you know his rule number 1. Never lose money. And then rule number 2. Never forget rule number 1. Simple, right? But behind that simplicity is one of the most profound wealth-building principles in history. Let's unpack what Buffett really means and how you can apply it. 1. Why losing money is worse than you think. Most people underestimate the cost of a loss. If you lose 50% of your investment, how much do you need to gain to break even? Not 50%. You need 100%. That's why Buffett protects his downside at all costs. He understands that the best way to grow wealth is not losing it in the first place. Think of compounding as a snowball rolling down a hill. If it melts halfway, you're starting from scratch. That's why Buffett says, rule number 1 is everything. 2. How Buffett avoids losses. Buffett doesn't invest in things he doesn't understand. That's why you never see him jumping into cryptocurrency or chasing trendy tech startups. If he doesn't understand the business model, the competitive advantage, and the future cash flows, he walks away. His filter is simple. Does the company have a moat, a strong competitive advantage? Is it run by competent, honest managers? Will it be around 10, 20, 30 years from now? If the answer isn't a clear yes to all three, Buffett says pass. He'd rather miss a good opportunity than lose money on a bad one. 3. Margin of safety. The secret weapon. Buffett borrowed this concept from his mentor Benjamin Graham. Buy $1 for 50 cents. In other words, only buy when the price is far below the intrinsic value. That way, even if something goes wrong, you still have a cushion. Buffett always builds this margin of safety into every deal. Think of it like driving a car. You guarantee speed on a narrow mountain road without guardrails. Margin of safety is your financial guardrail. For risk comes from not knowing what you're doing, Buffett says. Risk comes from not knowing what you're doing. Most investors lose money because they buy based on hype, emotion, or tips from friends. Buffett, he reads 500 pages a day, annual reports, financial statements, and market analysis, so he knows what he's doing. You don't have to read as much as Buffett, but you do need to understand what you're investing in. If you can't explain how a company makes money in one sentence, you probably shouldn't own it. 5. How you can apply rule number 1. Don't chase trends. If everyone is rushing into something, be cautious. Do your homework. Understand the business model, the risks and the upside. Demand a margin of safety. Don't buy at fair value. Buy at a discount. Stay in your circle of competence. Only invest in what you understand. 6. Patience is a risk management tool. Buffett often says, the stock market is a device for transferring money from the impatient to the patient. Most people lose money because they panic and sell during downturns. Buffett does the opposite. He waits for decades, his favorite holding period, forever. Why? Because owning great businesses for a long time reduces risk. Time is your ally if you choose wisely. 7. Cash is a risk buffer. Buffett always keeps billions in cash. Why? 2 reasons. Security. Cash helps him sleep at night. Opportunity. When markets crash, he has the ammo to buy great businesses at cheap prices. You can do the same on your scale. Keep an emergency fund so you're never forced to sell at the wrong time. In short, rule number 1 is not about being afraid, it's about being smart. If you protect your downside, your upside will take care of itself. In the next section, we're going to cover something that most people ignore, but Buffett mastered: patience, timing, and the art of doing nothing. Yes, you read that right. Doing nothing might be the most powerful wealth strategy of all. The power of patience and timing, why doing nothing makes you rich. If there's one thing Warren Buffett has mastered better than anyone else, it's the art of waiting. Sounds boring, right? Well, boring makes you rich. Buffett himself says, the stock market is designed to transfer money from the active to the patient. In this section, we're going to explore why patience is not just a virtue in investing, it's the ultimate competitive advantage. 1. The myth of constant action. Most people think making money in the market requires constant activity, buying, selling, day trading, reacting to every headline. But Buffett, he does almost the exact opposite. He spends most of his time reading, thinking, and waiting. He once said, the big money is not in the buying and selling, but in the waiting. So why is patience such a superpower? Because time is the friend of the wonderful business and the enemy of the mediocre one. 2. Compounding loves time. Remember Einstein's famous quote, compound interest is the 8th wonder of the world. Buffett took that to heart. He started investing at age 11. By 30, he had just over $1 million. By 60, over $3 billion. Today, more than $100 billion. Did he do it with crazy trades? Nope. He bought great businesses and let time do the heavy lifting. Think about it. If your investments grow at 10% per year, in 10 years your money doubles. In 20 years it quadruples. In 30 years it's 8x. Patience is like steroids for your portfolio. 3. The discipline of doing nothing. Buffett often compares investing to baseball. Most players swing at every pitch because they're afraid of striking out. Buffett, he waits for the perfect pitch, the fat pitch he knows he can hit out of the park. In investing terms, that means waiting for the right company at the right price. That could take years. But when it comes, he swings big. This is what he calls waiting for the no-brainer deal. When you have cash ready and patience on your side, those opportunities make you rich. 4. Patience in market crashes. Here's where patience pays off the most. During market crashes, most people panic and sell everything at the bottom. Buffett, he waits calmly and then buys businesses at fire sale prices. In 2008, when banks were collapsing, Buffett invested billions in companies like Goldman Sachs and Bank of America on his terms. Those deals made him billions. Why? Because he had cash plus patience, he says. Be fearful when others are greedy and be greedy when others are fearful. That's patience in action. 5. Timing is about preparedness, not prediction. Here's an important truth. Buffett never tries to predict the market. He doesn't know when the next crash will happen, and neither do you. Instead, he prepares for it by staying patient and holding cash. So when everyone else is panicking, he's shopping. That's why timing is about readiness, not guesses. 6. How to practice patience in your own life. Stop checking your portfolio every day. It only creates stress and bad decisions. Think in decades, not days. Ask yourself, will this company be stronger in 10 to 20 years? Keep an opportunity fund. Cash is your friend when the world is on sale. Avoid the noise. Ignore headlines designed to make you panic or rush. Buffett once said, the stock market is there to serve you, not to instruct you. You don't need to act every time it moves. Just wait. 7. Doing nothing is hard but worth it. Why do most people fail at patience? Because doing nothing feels wrong. Our brains are wired for action. We think, if I'm not trading, I'm not making progress. But in reality, wealth building is a game of inactivity punctuated by a few big moves. Buffett is living proof. His biggest wins came from waiting for years and then acting decisively when the time was right. Final thought on patience. If you truly want to be rich like Buffett, embrace boredom. Let time work for you. Let compounding do the heavy lifting. And remember, the trick is, when there's nothing to do, do nothing. Reinvesting dividends, Buffett's quiet compounding engine. If patience is the engine of wealth, then dividends are the fuel that keeps the machine running forever. Warren Buffett is obsessed with businesses that generate predictable, growing cash flow, because cash flow is freedom. And here's the kicker. He doesn't just pocket that cash. He reinvests it, again and again. This is how his wealth snowball became an avalanche. 1. Why dividends matter so much. Buffett's portfolio isn't just a collection of stocks, it's a cash flow factory. Companies like Coca-Cola, Apple, and American Express send him billions in dividends every year. For example, Coca-Cola Berkshire owns over 400 million shares. That means $704 million in annual dividends just from one company. Apple Berkshire's stake generates more than $800 million a year in dividends. And guess what? Those dividends don't sit idle. They're reinvested into more businesses, which produce more cash, which gets reinvested again. That's the compounding loop. 2. Reinvesting versus spending. The Buffett discipline. Most investors take dividends and spend them. New car, fancy vacation, whatever. Buffett does the opposite. He never breaks the compounding chain. Every dollar that comes in gets reinvested, so his money works harder every year. Think about this. $1 reinvested at 10% becomes $6.72 in 20 years. At 50 years, that same dollar becomes $117. That's the magic of reinvesting, not just growth, but exponential growth. 3. The double power of dividend growth. Buffett doesn't just buy companies that pay dividends. He buys companies that raise their dividends year after year. Why? Because increasing dividends mean your income grows without new investment. The business is healthy and profitable. Coca-Cola, for example, has increased its dividend for 60 consecutive years. That's what Buffett calls a forever stock. For cash flow equals optionality. Dividends and cash flow give Buffett something most investors lack: options. When you have steady cash coming in, you're never forced to sell assets in a downturn. You can buy more instead. This is why Buffett loves businesses like railroads, utilities, and insurance. They produce endless streams of cash. That cash becomes ammo for his next big move. 5. How you can apply this principle even if you're not Buffett. You can choose dividend-paying stocks with strong histories of growth. Reinvest your dividends automatically. Most brokers let you do this for free. Focus on companies with pricing power. They can raise prices without losing customers, which protects your dividend stream. Think in decades. Dividend reinvestment isn't a quick flip. It's a slow burn that makes you rich later. 6. Real example. Buffett's Coca-Cola dividends. Let's do some quick math. In 1988, Buffett bought Coca-Cola stock for about $1.3 billion. Today, he collects over $700 million a year in dividends from Coke alone. That's over 50% annual return on his original investment just from dividends. And here's the kicker. He doesn't sell. He reinvests and keeps compounding. 7. The psychological advantage. Dividends also give investors emotional stability. When markets crash, price goes down, but your dividend check still arrives. That consistency helps you stay invested, which is half the battle. Buffett loves this because he doesn't have to guess the market's mood. He just collects cash and reallocates it. Final thought on dividends. Buffett's wealth wasn't built on hot stocks or timing the market. It was built on buying great businesses, reinvesting every penny and letting time do its thing. He calls it the snowball effect. Start small, keep rolling, and one day you have a mountain. Buffett's biggest mistakes. And what you can learn. Yes, Warren Buffett is the greatest investor alive, but guess what? He has made some massive mistakes and he's the first to admit it. Why does this matter? Because studying his failures is just as valuable as studying his successes. If the Oracle of Omaha can make errors, so can we, but the difference is, we can learn from his experience without paying the tuition fee. 1. The Dexter shoe disaster in 1993. Buffett bought Dexter Shoe Company for $433 million. He thought it was a strong brand with lasting competitive advantage, but guess what? Foreign competition crushed Dexter. The business went to zero. And the worst part, Buffett paid in Berkshire Hathaway stock. Those shares would be worth billions today. Instead, they're gone. Buffett called this the dumbest deal I ever made. Lesson. Never assume past success guarantees future advantage, and when possible, pay in cash not stock when you're unsure. 2. The airline addiction. Buffett once called airlines death traps for capital, yet in 2016, he bought big stakes in Delta, American, United, and Southwest. Then 2020 happened. The pandemic crushed airline demand, and Buffett dumped all airline stocks at a loss. Lesson. Even Buffett breaks his own rules sometimes. Avoid industries with high fixed costs and cyclical demand. 3. IBM, a tech misstep for decades. Buffett avoided tech stocks because he didn't understand them. But in 2011, he made a rare move, bought IBM. He thought IBM had a durable moat, but cloud computing disrupted everything. IBM struggled to adapt. Buffett sold his stake in 2018 at a loss. Lesson. Stick to your circle of competence. If you don't truly understand the business, pass. For Tesco trouble in 2012, Buffett bought big into Tesco, a British retailer. Soon after, Tesco was hit by accounting scandals and profit warnings. Buffett sold with a $444 million loss. Lesson. Management integrity matters as much as financial metrics. Buffett says, when a management team with a reputation for brilliance tackles a business with poor economics, it's the reputation of the business that remains intact. 5. The big one that got away, Google and Amazon. Buffett admired both companies early. He even used Google for Berkshire's insurance ads. But he didn't invest. Why? He didn't fully understand the business models at the time. Those missed opportunities cost hundreds of billions. Lesson. If you understand the business and believe in its moat, don't hesitate too long. Buffett himself said, we were too dumb to realize. 6. The cost of conservatism. Sometimes Buffett's biggest mistake is not acting. He holds tons of cash, waiting for the perfect pitch. That discipline is great, but it also means missed opportunities. In a raging bull market, cash earns nothing. Lesson. There's a balance between patience and paralysis. Buffett can afford to wait because he has scale and options. Most of us, we need to stay reasonably invested. What do these mistakes teach us? Stay in your circle of competence. If you don't fully understand a business, skip it. Don't let ego override discipline. Even Buffett broke his rules, and paid for it. Avoid industries with terrible economics. Airlines, anyone. Beware of overconfidence in moats. Competitive advantages erode faster than you think. Patience is good, but perfectionism can cost you. Buffett's perspective on mistakes. Here's what makes Buffett different. He owns his errors. He writes about them in every annual letter. No excuses, just lessons. His philosophy. It's good to learn from your mistakes. It's better to learn from other people's mistakes. The biggest takeaway: Buffett's mistakes didn't ruin him because he followed risk control principles. Never bet the farm. Keep a margin of safety, diversify wisely. That's why even billion-dollar blunders couldn't sink him. Final thought on mistakes. If Warren Buffett can be wrong and still end up worth $120 billion, what you can achieve by learning from his errors before you make them. Subscribe to Wealth Cipher right now and hit the notification bell so you never miss strategies that could change your financial future.